SIPs have done for somebody who have seen both the cycles, upside and downside. So what we did was that we took out data for last 26 years of two investors. One investor who made less than 8% returns in the first 5 years, and somebody who made more than 8% in the first 5 years. So it's basically now, the second investor who was happy for the first 5 years because his SIP returns were always more than 8%, he actually ended up making a tag lower return than somebody who had first 5 year returns less than 8%. Why did this happen? Because this investor, the 8% or less investor, for first initial period of his total journey, he was accumulating more units.
Hello, everyone, and welcome to another episode of Ask the Expert series. I'm Surbhi Chandak, a qualified chartered accountant and currently serving as an associate vice president at AIF PMS Experts India. In this series, we bring valuable expert insights from various sectors and asset classes to share with our investor community. I'm pleased to introduce Mr. Vaiibhavv Chugh, the National Sales Head for the Wealth and Retail Channel at White Oak Capital Asset Management Limited. Hello, sir. Welcome.
Thank you.
Let me take a moment to introduce sir. Mr. Vaiibhavv Ji has over 20 years of experience in retail sales and distribution. Mr. Chugh has an impressive career spanning renowned organizations such as ICICI Prudential AMC, IDBI Principal AMC, and Franklin Templeton. Notably, he spent 14 years with Aditya Birla AMC, where he held various roles across North, South, and West India. He served as the zonal head for the West Zone, overseeing all distribution channels and also managed HNI sales nationwide. Yes, sir.
Thank you. Thank you so much.
Our topic for today is quiet compounding. Before we start, let's actually have, can you just explain, sir, about the White Oak Capital AMC and its products?
Sure. So thank you, first of all, to you, Vikas, and everyone at AIF and PMS for this wonderful opportunity to interact with you and all your investors. See, White Oak is an investment boutique firm which started in 2017. Our founder, Mr. Prashant Khemka, has been a fund manager all through his life. He started his career in 1998 with a firm called State Capital in US, and in 2000 he joined Goldman Sachs in US. From 2000 till 2017, till the time he formed White Oak, he was with Goldman all through those 17 years, and he managed funds in United States of America, in India, and also he was later he moved to Singapore to head the entire global emerging markets for Goldman. So like I said, that this is an investment boutique firm. What I really mean to say is that the background and the expertise and the pedigree which we bring to the table is only and only investments, which comes through our founder, Mr. Prashant Khemka. In fact, all our other management members, like our CIO, Ramesh Mantri, has also been only and only an investor all through his life. Our CEO, Mr. Ashish Somaya, has also been, he has been with the industry, from start of his career, which was in 98-99. So you can see that, this is one firm which has professional managers with vast experience, with experience of various geographies. And of course, from 98 till now, there have been so many market cycles that they also bring the experience of going through various market cycles. So 2017 is when we started our business. We started with AIF and PMS products and also offshore products. In 2022, we launched our first mutual fund, which was FlexiCap Fund. And today we manage about 16 schemes, and we manage about 18,000 crore of total assets. On PMS and AIF, we manage about 10,000 crores in India and 55,000 crore of offshore. So Vaiibhavv is an investment management firm which manages about 87,000 crore of assets, out of which, like I said, 55,000 is from overseas investors and about 27,000 is of onshore investors. And we have products across PMS, AIF, mutual funds. So that has been the journey. And we have more than 650,000 unique investors, and an SIP book of about 200 crores as we speak.
Okay, sir. Okay, thank you. So, our topic for today is quiet compounding. So, I would like to, Mr. Vaiibhavv Ji, can you shed some light on what is quiet compounding and how investors investing through SIP can benefit from this?
Sure. So if you allow me, I'll just share my screen. So just give me a couple of minutes. I'll quickly run through a couple of slides to explain what exactly I meant. See, and let me start with the current context. The current context is that we have so many news going around. Of course, it started sometime back in September, October, when we had the peak of our equity market, September 24. And from thereafter, we have been getting so many news. It started with money moving from India to China, and then Mr. Trump got elected, and then markets started getting fearful that Trump tariffs will come and how will he make America great again, and how will that impact markets around. So we have been surrounded by so many news which have been creating kind of jittery. It has been creating volatility in the minds of people. Markets will go down, China will take off money, India has been expensive. So if you remember September 24, this is something which was going around us. Now, when so much of news is going around us, and we see also when we see market spikes, then it comes to our mind कि यार कैसे चुप रहे, should we really move out of the markets? Should we invest more? Should we stop our SIPs? And therefore, we said through quiet compounding that the bend which we are seeing in the market, which is that market was going smooth up till September 24, and then some news came, and everyone thought that road is going to end. But what we have been telling everyone, that bend in the road is a feature of the market. It is not a bug. That is how equity markets have worked from the time memorial. Like, for example, the history of Indian markets, for instance, if you look at, right from, if I have to plot from last 30 odd years, from 1994, there have been many reasons where an investor would have thought of taking some action, like September 11, dot-com bubble, 2008 subprime crisis, 2013 taper tantrum, 2015 banking crisis, 2018 NBFC crisis, 2020, each one of us thought that we will become dinosaurs. Humans will go out of the earth. COVID will make sure that no human survive, and so on and so forth. Markets have always given reasons of getting volatile. So that has been the feature of the market. But what we forget is that from 94 till now, markets have given a compounding return of about 13-14% compounded for 30 years, and that's a phenomenal number. But the journey has not been smooth. Now, by quiet compounding, what I mean is that, one, we need to understand that is the feature of the market, which is volatility. But if a country is bound to grow, if the GDP of a country is going to grow, and you and me, we are going to contribute in the GDP growth, there are a lot of companies which will benefit out of, you and me earning, you and me spending. And if we become owners of those companies, it is quite possible that we will end up making money. But yes, the journey will not be smooth, because how do markets work? Market works by having buyers and sellers simultaneously in the market. So for example, if there is a news which comes today, XYZ, and if there are 10 investors in the market, it might be a case that 8 investors believe that this news is not good and I will sell my stock portfolio. two investors will believe that no stocks will go through. But because on a particular day or in a particular period, number of sellers are more than the number of buyers, what we see that market goes down. Ultimately, market is sum total of buyers and sellers. But when there are more number of sellers, it does not mean that the business will vanish. Like for example, uh, I'll give you example of say 2008 crisis, Ireland FS crisis. Everyone thought that this uh, problem is going to go berserk. There will be no lending because Ireland FS was such a big entity. How will other banks get impacted? How will other corporate get impacted? But you tell me how many branches of a particular bank you saw which closed their business or they closed their branches. It did not happen. But for particular period of time, everyone was skeptical that the lending will not happen for long, consumption will not be there. So let me sell, let me sell, let me sell. So we always forget that markets react to news. When there is a news or when there is an event, people will either positively take that in their stride, or they may take it negatively. And if there are more sellers, then the market will fall. Uh, so if I can take a couple of more minutes, see what all of us have also read and heard, that markets are inefficient. What is the meaning of market being inefficient? That the flow of information is not same for everyone at a particular time. You may have more information than I may have. You may perceive that information in a different manner. I may perceive in a different manner. Till the time markets are inefficient, it is good for investors uh, because if you are able to focus on a particular business and you can foresee a business growing over a period of time and you don't react to news, it is quite possible that you will ride through the journey and your portfolio will also see a graphical increase, which we are seeing as on the screen. Another thing, one moment. Another thing, quite compounding, uh, like I was saying that a lot of people look at short-term returns, a lot of people look at what is the news around. Like this data is of very recent time. This is as of March end. Now in March end, when I was to look at my portfolio or invest or in general market, 1 month, 2 month, 3 month, 6 month, 9 month, everyone is looking negative. Everything is looking negative. Median flexi cap returns of all the flexi cap funds in the market, average returns are also looking at negative. While we are focusing on negative return in the short term, what we forget is that despite of this negative return, the long term returns are still very, very positive. Now there are two ways to look at it. That I look at short term returns and I disturb my portfolio. I move out, I stop my SIP, I redeem, and so on and so forth. Another is somebody like this who will say that okay, short term though volatility rehta hai because that is the feature of the market, that is how markets work. But in long term, my portfolio is still yielding a compounding return of 18%, 13%, or whatever that number is. So therefore, if you look at long term, if you continue staying on your goal, the chances are that, if you don't act, if you manage your anxiety when the markets are going other way around, that is when quietness of mind, quietness of not reacting to market news is eventually what will make money, like I was showing in this particular slide. So that is precisely what quiet compounding is, that in times like these when there are so many news flows and even the Excel sheets are showing negative returns, just stay calm, uh, and look and focus on your goals, focus on whatever career you are into, and let the long term compounding work for you. And that is why I've got this quote, that we must free ourselves of the hope that sea will ever rest. We must learn to sail in high winds. And now correlate to what I said some time back, that the volatility is the feature of the market. But in compounding, all of us know what compounding is. One of the biggest rule of compounding should be that we should not never disturb compounding. and that is when the compounding will actually work. Otherwise, it is not compounding, it is only incremental return. So for one to understand what is the difference between incremental returns and compounding is an element called disturbance. If you don't disturb, you compound your money. If you disturb, you still may make money, but that will be only incremental returns.
Yes, agreed, sir. Okay.
Ji.
So, also investors who are doing SIP, how can so you are telling that just keep your SIPs on, just
Yes,
let it quietly compound itself. What
absolutely.
happens when the markets are volatile and it kind of affects the compounding?
Sure.
So how to perceive that?
Yeah. So that's a very good question, and thanks for asking that. So I have also some data for you, and this data is from 1996 to 2024. So you can understand that that's a very, very long-term data. What happens is that what we try to do as the question which you asked, there are a lot of investors who keep asking us. So we thought that rather than giving a ballpark figure and a ballpark narrative, let us go and do some analysis, data analysis, to find out that how exactly uh, SIPs have done for somebody who have seen both the cycles, upside and downside. So what we did was that we took out data for last 26 years of two investors. One investor who made less than 8% returns in the first 5 years, and somebody who made more than 8% in the first 5 years. So it's basically now, the second investor who was happy for the first 5 years because his SIP returns were always more than 8%, he actually ended up making a tag lower return than somebody who had first 5 years of returns less than 8%. Why did this happen? Because this investor, the 8% or less investor, for first initial period of his total journey, he was accumulating more units. This particular person was also accumulating units, but at a higher NAV. So what happens is that when you accumulate more units at lower price, then when the market moves up, then the chances of you making better return than somebody who has always seen positive or higher returns will be much higher. See, there are two kind of bullishness. Like there are a lot of WhatsApp messages also revolving. I'm sure आपने भी देखा होगा that there are two kind of bullishness in the market, or two kind of bull runs in the market. One is of the NAVs, second is of the units. So my sense is that somebody who has started SIP but initial returns are low, they should actually wait and let the compounding on this number of units which they have acquired at a much lower rate work for them, and their compounding will be much more than somebody who has always in good times. So I've been also telling a lot of investors and in my family also that we started some of the SIPs we started last year. Every year some salary will go up and people will start SIPs. The SIPs which we started last year, I was speaking with my wife also. That SIP is going to compound more for us because most of the units have got acquired from September 24 till now when the markets have only gone down. So I have acquired more number of units at much lower price, and
Yeah.
therefore over period of time those number of units will compound more for us. Another thing, if I may take more time,
Definitely,
uh,
sir. Yes.
yeah, and this will really answer your question in more detail. Now, what we have also done, same again for last 28 years, we have taken the data of PSE Sensex, which is our stock market. Somebody who started 10,000 rupees ka SIP, and this is all data, right? This is no narrative. Now, in September 96, the index was 3563. Now, imagine if you and me, we are an investor, and if I was to start my SIP, what would be my initial thought? That ठीक है यार मैं SIP तो करता हूँ, but let the markets correct, let market come down. So imagine this investor knew when the market will correct, and he waited for about 3-4 months. market also corrected by about 21%. So what he expected, that got delivered. But what happens in long term? While this person was trying to find the lowest end of the market, but the other investor who had invested in September 96, because 3 month investment, more three installments of 10,000 more than the other investor, eventually when markets did whatever returns they gave, he actually accumulated 14.7 lakh rupees more. Oh, sorry, zero 0.3 lakh rupees more. No, my bad. He invested, like I said, three installments more, 30,000 rupees. 30,000 rupees compounded at 14 and a half. Actually, he made 14.7 lakh more than the investor who started at the bottom. You getting my point? Similarly, any instances of the markets you see that somebody who came in 97, index was 4617. Now he said that, okay, I'll wait for market correction to happen. So he also waited. Market also corrected by 37% in 97, 98. But this person invested 1.5 lakh more. Why? Because the period between August 97 to 98 is more than 1 year. In more than 1 year, in fact, 15 months. In 15 months, the person invested more, 1.5 lakh rupees more, not waiting for the correction to happen. Now, not waiting for correction to happen, and this extra 1,15,000 and extra 15 months, actually at the end of 28 years, the person ended up making more, 49.5 lakh rupees more than the other investor who was waiting for the correction to happen. Any correction you see in the market, in the history of our stock markets, anyone who has tried to wait, he probably, if the God is with you and you are able to find the bottom, then you can still pick the bottom. However, but because somebody is investing with patience, discipline, and not really looking at markets to go up or down, has just ensured that he invests at regular intervals, every single investor has ended up making more money. So therefore, one, in falling markets, one should be happy that they are accumulating more number of units. And second, if markets are at high, then also don't wait for market bottom to happen. It is the time in the market which matters more than timing. So both sides, one can correlate to what quiet compounding is. Then when markets are high, don't wait for market bottom. When markets are at bottom, don't wait for market to correct and then start investing. If you are investing, just stay put and let the compounding magic work for you.
Thank you. That's a nice way to explain that. Keep your SIP going and let the compounding magic happen.
Absolutely.
Okay. So one more thing I wanted to ask is, an investor wants to invest in SIP. How much should the asset allocation be, and in mutual funds, and the exposure that one should have in a particular asset?
Okay, sure. See how much ka actually best answer an advisor like yourself you can give, because if I, for example, if I as an investor I will have some goal for which I want to invest, right? That goal might be 1 year away, that goal might be 10 years away, and that goal might be 20 years away. For every need and for every time horizon, mutual fund industry now has a product, right? So for example, if I come to you and I say that I want to save for 1 year, there are debt funds. If I come to you and I tell that I want to invest for next 20 years, of course, there are different kind of products. There are different kind of products. From cradle to grave, like we say, there are products. Now, mutual funds, for any long-term investment requirements, one can definitely look at mutual funds, because mutual funds are like, our fund managers, they have capability to find good stocks for you. See, if I have to buy a stock today, I will have to do a lot of research. My background has to be very, very robust, both in terms of finances and both in terms of education. My research has to be top quality. All that one cannot do. So one can give the money to a fund manager, and he or she can manage the money quite appropriately. So mutual funds, they are the right tool, because one, they have products to offer. for a particular goal, for a particular time horizon, for a particular risk appetite also. And a good advisor can help allocate between all asset classes. But yes, one has to ensure that asset allocation is in place. Why? Like I said, that if you come to me and you say that I have to invest for 5 days, I will be a fool to suggest you an equity fund. I will say that okay, invest in a liquid fund. But you come and tell me that Webber, I have some money which I will require in 1 month, and some money I will require in 3 years, some money I will require in say 10 years. Then the beauty of mutual fund industry is that I'll be able to give you a product for 1 month money. There will be a different product for 3 year money, and there will be a very different product for 10-year money. So therefore, your asset allocation will be across 3 different asset classes. But at the same time, asset allocation also helps you get products which are proportionate to your risk horizon, to your time horizon also. So that is one. Number two, that like you said that mutual fund में क्या करना चाहिए, डालना चाहिए कि नहीं डालना चाहिए. So let me try to answer that one another data point. Just give me a minute. Yeah. See, this is again data for our index BSE, right? What we have done is we have taken the rolling return. Now, what is rolling return? That, for example, you start your SIP today, from today to 5 years. I start my SIP tomorrow, so from tomorrow to 5 years. Somebody starts day after, from day after to 5 years. It's a rolling return that in last 5 year, 10 year, 15 year, any day you had invested, any time in the last 15 years, and you had invested for next 15 years, right? So that is the rolling return. Now, how to read this particular slide? This is for the index. Mutual fund returns are a little better than index because on an average, mutual funds have outperformed index by 2 to 4% or 5%. But for this discussion, let us look at BSE Sensex return and mutual fund return. Now, somebody who has invested for 3 years, on an average, the median returns are 12.5%. Somebody who has invested for 8 years, 14.5%. Somebody who has invested for 12 years, 14% plus. Somebody who has invested for 15 years, 14% plus. So if the horizon is long, one, we have seen in long term that markets have given 14 to 15% kind of CAGR returns. Mutual funds have actually given a little more than that. But what is also required to be seen is how many times an investor would have seen positive returns. In long term, every single investor in the last 8 years, 10 years, 12 years, 15 years, whenever they started, market bottom, market high, black Monday, black Tuesday, does not matter. कभी भी इन्वेस्ट किया था पिछले 8 साल में, 100% of the time positive returns. Last 5 years, 92% of the time positive returns. And last 3 years, 85% of the time positive returns. And therefore, we tell that if your goal is clear, you should definitely look at equity investing for long term. Not only they have given positive returns, but you look at these returns, they are also superlative, I would say. Superlative compared to any asset class which you may look at. One, there is no asset class which is as liquid as equity investment. You know, for example, people compare equity funds with real estate. Real estate is not a liquid asset. Gold is not a liquid asset. Debt and FD, they are liquid assets, but then return differential is very, very high. So in long term, if you have to beat inflation, you have to reach to your goal, and you want compounding magic to work for you, the compounding magic will work not only in terms of getting positive return, but also quite decent returns. That is one. And where should one invest? Like I will reiterate that please reach out. I mean, your investor should reach out to your team to find out which is the right asset allocation for them. If they are able to identify their goal, if an investor is able to identify the goals, I am sure AIF and PMS team will be able to marry a product to a goal, marry a product to a risk appetite. And that is how asset allocation will work. But yes, in long term, in general, we have seen mid caps have outperformed large caps, and mid caps have also outperformed even small caps. So I would recommend that one should look at investing in multi-cap, flexi-cap kind of category, which will have investments in all the three market caps, but of course for long-term investments.
Can you elaborate more on the White Oak capital products that you have for the asset allocation, the different products for multi-assets?
Yes, sure. So in terms of our products, see, we have category of products across equity, diversified. We also have thematic funds, and we also have hybrid funds. At the same time, we have products which is for a very short period of investment horizons. So we have Flexi Cap Fund, which is our flagship fund. This product was launched in 2022. In August of this year, start of August of this particular year, this fund will complete 3 years. Mid Cap Fund is our only SIP fund. We don't take more than 1 lakh lump sum in this particular product, and this product will also complete 3 years in September. Large Cap Fund, which is as the name suggests, this fund invests in large cap oriented large cap stocks. Multi cap fund is one product which is a little aggressive fund from our side. The endeavor of this fund is to invest about 60-70% in small and mid cap, followed by the remaining in large cap. Large and mid cap invest in both large cap and mid cap stocks. We have also have ELSS fund. In terms of in terms of hybrid category, so hybrid category is a quasi asset allocation fund wherein investors can look at investing in products which will automatically shuffle between equity and debt, equity, debt, and gold, so that they always need not take a call on looking at what is happening in market and therefore changing their asset allocation. The fund manager and the model of the product will automatically maneuver between equity, debt, and gold, depending on which product are you investing in. So balance advantage fund, for example, will navigate between equity and debt. Multi-asset allocation is one fund which will have equity, gold, debt, and some foreign equity also. And the fund manager and the science which White Oak has curated will maneuver between all the three asset classes which I spoke about. We also have balance hybrid, which is again a very unique fund. In this fund, we try to keep asset allocation between equity and debt 50-50%. So whenever say equity crosses say 58, 59 and debt goes down to say 42, the model will shift back to 50 equity and 50 debt. So we also have thematic funds, which see, one thing which I forgot to tell was that White Oak is also one team which is one of the largest investment professionals team, consisting of fund managers and research analysts. And because we have such a large team, we have capability of finding stocks across various sectors. By virtue of that, we also launched these thematic funds which cater to a particular theme or portion of the market. But all these names which you are finding on the screen are structural thematic funds. They are not tactical that aaj dalo aur 2 saal ke baad aapko exit karna pade. So banking and financial, for example, is one product which you can look at for next 20-30 years. That's how India will grow. Similarly for pharma, similarly special opportunities, which is more like a contra fund. We also have Digital Bharat. It does not mean that it will invest only in IT, software writers or those kind of companies. Digital Bharat means India is progressing both as a manufacturer of IT services, AI, ML, and marketplace, etc., etc. And there are a lot of companies which are benefiting because of usage of IT services, etc. So this fund, environment, social governance, and the fund will invest in the G part, which is the governance part. In this particular fund, our fund managers try to find companies which are best in class as far as governance is concerned, because our sense is that a company which has very strong governance, the probability of that company to survive for 20-30 years is much higher than somebody which is doing well in the recent time, but the governance is not that strong. And we also launched one quality equity fund. By the way, this is India's first actively managed quality equity fund, quality factor fund, actively managed. In this fund, we invest in companies which the fund managers identify on quality as a factor, like profitability, cash flows, return on invested capital, the leverage ratios, etc. By looking at these factors, the fund manager find companies which qualify as quality in quality factor, and then we create the portfolio. Liquid and ultra short are very short-term products where which you can use for your parking for 1 year, up to 1 year, few months, few weeks to up to about 1 year. So these are the product categories which we have at White Oak.
Okay. Okay, so my last question to you, sir, is what is your view on the current market scenario, and how do you handle the client concerns during these volatile markets?
Yeah, so it's actually, see, all of us understand what is going around. The markets currently are quite volatile because the world is not able to understand that how will this really play out, the entire tariff war which has started. Of course, there will be a lot of repercussions on many economies, and because we live in a world which is interconnected, if there are more tariffs on, say, China, it will have repercussions on a lot of economies. Not only that, their exports become difficult, but what happens is that their export to America becomes difficult. They might come and start dumping in some other countries. So it might be a problem for some other countries where the dumping starts. Uh, for local manufacturers also who have been export oriented with higher tariffs, how will they maneuver? How will they navigate journey forward? How will they increase their sales? Will the inflation go up in US? Will the US central bank stop cutting the rates? Uh, if exports, if I don't do export as a manufacturer because tariffs are going high, I need to have local consumption so that I can sell my products, if not outside the country, but within the country. Now, many countries are consumption driven, many countries are not not consumption driven. So all said and done, and see, we still don't know that if Mr. Trump will agree for negotiations, if there are more countries which will retaliate, uh, what will India do? Most likely we are going to negotiate. So all of us understand that there are so many news flows around which will ensure that this volatility continues for some time. So in short term, the markets are going to be volatile for the reasons which I mentioned, across the tariff spectrum. But if I sit back and think about September 24 or August 24, when the market started falling, what were the reasons which were telling everyone that markets may fall? One was that everyone was saying that markets are very overvalued. Markets were at high and profitability earning numbers were looking low. Today, markets they have already corrected. We are around bottom. If not bottom, we are around bottom. But most of the companies are now talking about better earnings in the forthcoming 2 years, 3 years. Now, in September, we were all thinking that because government capex has not been there, consumption was in urban India was also not that great, and markets were at high. Everyone was talking about that यार markets तो ऊपर है but earnings का number अच्छा नहीं लग रहा है, and therefore markets fell. But for the same reason, today there are reasons that why we should be investing again, because markets are at bottom now, but 2 year and 3 year earnings are looking much better than they were in the last 8-9 months or even in the last financial year. In September, June, July, August, I mean that period, dollar index was like 109 or thereabout. The US interest rates had shot up to the bond yield, sorry, had shot up to about 4.85. Today, the bond yields have come down. Even the dollar index is down to 104. Interest rates in India have got cut. We also have seen CRR liquidity coming in. We have also seen income tax cut in the recent budget. We are also seeing the banks have started lending. Now, all these were the reasons of fear some time back, which have now turned, which have actually reversed. So if I look at that, the local concerns, according to me, are mostly behind us. But yes, there are concerns like tariff, which no one knows how will it really play out, what will be the end result, by when things will settle. So we believe that it is good to be cautious currently, it is good to be investing only through SIPs or in a staggered manner. But we should also keep in mind that bottom is around us because most of the negatives are behind us, which I just explained some time back. But yes, tariff thing and how trade will really evolve across the world, no one knows. Until that time, I would recommend to go slow. I would recommend very strongly to look at investing through SIPs. I would strongly recommend that even if you have to invest lump sum, just invest about 30-40% now, and over next 2-3 months one should stagger and get into the market. But don't take very long also to come into the market, because markets will never give you a heads up that bottom is, I'm making the bottom, now you start investing. I think somewhere you'll have to start buying out of conviction that enough correction has happened. The markets have factored in all the tariff issues, and now someday we will come back. I think that moment will come in 2-3 months from now.
Okay. Thank you so much, sir. That was a great view and nice explanation to the markets. All right, sir. Thank you so much for your valuable time. Thank you for such a nice session and a lot of insights I've received and our investors. So thanks a lot.
Thank you. Thank you for the opportunity.